Hi clients, good morning everyone. Happy Chinese New Year. Today we'll be talking about our new initiation on First Resources. We published our report today, as you can see on our Poyuan platform. First Resources, this is a company snapshot of First Resources. It closes at 199 last week. Its market cap is around 3.2 billion Singapore dollars. Target price for First Resources is 235. Right, basically, First Resources has two main business segments. It is an upstream-focused plantation company with plantations over in Indonesia, both in Sumatra and Kalimantan, both east and west. Its plantation segment contributes 95% of its EBITDA. This will be our main focus for the day. It has over 160,000 hectares of planted areas, which is equivalent to about more than 2 times the size of Singapore. It has also 140,000 hectares of unplanted land bank. This should be able to sustain the annual planting rate for over 5 years. Next, second is its refinery business. This is the midstream business. It has basically 2 fractionation plants with an annual capacity of 850,000 tons per year, as well as 1 biodiesel plant, which has a capacity of 250,000 hectares, 250,000 tons. This contributes 5% of its operating profit. Here we can see that the location of its business operation over in Sumatra and Kalimantan. It has a plantation. Most of its plantation assets are in the Sumatra area. They are starting to plant more assets over in West Kalimantan. They also have a substantial amount of plantation assets over in East Kalimantan. They have offices both in Singapore and Indonesia, as well as the capital of Indonesia in Jakarta. They also have processing refinery plants over in the Sumatra area. They just completed the 600,000 tons capacity new refinery plants end of last year. This boosts the refinery annual capacity up to 850,000 tons per annum. This is the general view on this value chain of First Resources. Basically, it has the main focus is their plantation assets, which spreads around Sumatra and Kalimantan area. After the plants have been ripe, the FFB will be sent over to the mill plants where they will be milled to produce CPO and palm kernel. And upon further request, they will also be transferred over to their processing refinery plants to undergo further processing so as to produce more refined products such as RBD palm oil, palmolene, palm stearin, biodiesel, all this upon further request from the client. So what are the investment merits for First Resources? Basically, we list down 3 main merits. First is its young age profile, which is expected to drive production growth over the next 5 years with a CAGR of 12%. Second is its is that it is the lowest cost producer of a CPO within the industry itself, both in Indonesia and Malaysia, thanks to its best-in-class operational efficiency as well as stringent cost management. Thirdly, is because of its attractive valuation as compared to the industry peers. It is currently trading at less than 10 times FY15 PE, whereas other players are actually trading at a slightly higher PE of 12 to 13 times. That's going to further details on why we see First Resources having a strong production over the next 5 years. First Resources Plantation Estate has an average age of 8 years old as of end 3Q13, and more than half of its plantation are less than 7 years old. This should drive substantial productivity gains over the next 5 years as new assets kicks in. As you can see on the diagram below, the prime production period for palm trees are actually between 8 to 17 years old. So over this period of 10 years, CPO production is expected to peak, and with an average age of only 8 years old, we believe that the plantation assets for First Resources will be expected to grow over the next 5 years as new plantation assets kicks in. Based on our estimates on the First Resources plantation profile, we expect the mature planted areas to grow at an annual CAGR of 12% over the next 5 years. As you can see on the diagram on top, and we are modeling in recovery of yield over the next few years, as the for 2013, yields were slightly affected due to two main reasons. One is the newly acquired assets, as well as the biological downtrend, which actually affected yields industry-wide. Plantations over in Indonesia side, due to the younger age, are actually affected due to the bumper harvest in 2012, and this has resulted in a lower yields in 2013. But we see that the recovery is expected to occur in 2014. Based on the fact that the trend should increase, should result in a better yield this year and the year after. And with generally gradual rising of yields, as well as more mature plantation assets kicks in, this should drive a strong production growth over the next 4 to 5 years. Next, it's a low-cost structure. For First Resources, we understand that the cost of production is at $238 per metric ton in 2012. If you compare it to the other upstream planters within the industry, you can see that you can see on the diagram on top, you can see that First Resources is the lowest cost CPO producer within the industry itself. The closest competitor is actually Golden Agri, which has a cost of production of around slightly less than $300 per metric ton. Management attributes this low cost of production due to its best-in-class operational efficiency as well as stringent cost management. They actually, for their plantation assets, in fact, they actually they actually come up with a harvesting plan that actually optimize the harvesting period of the FFBs so as to maximize the quality and quantity of CPO produced and minimize wastage. And this actually resulted in a higher yield and margins, as you can see on the diagram below. If you compare it over the industry as a whole, First Resources actually has one of the highest CPO yield as compared to its peers. This has actually resulted in a higher net margin. And with this higher yield, this will actually provide greater resilience to price cycles for First Resources, given that it is within the commodity industry itself. Here you can see that on the diagram on top, you can see the cost of production is expected to rise substantially over the in 2013 due to two main reasons. Due to one main reason, one is the higher minimum wage in Indonesia. For Indonesia side, they actually has minimum wage increase annually, but in 2013, the increase is as higher as compared to the last few years, and this has resulted in a higher cost of production in 2013. But this actually occurs industry-wide, so we are not that concerned because it is actually affecting planters within Indonesia itself. And given the fact that First Resources has the lowest cost of production, this should be less impacted for First Resources. And what we get from our management is that they have actually locked in the price of the fertilizer cost, and this should offset the higher annual wage increase for 2013. Based on the diagram below, you can see that the fertilizer and labor cost actually takes up more than 75% of the total cost component for the production of CPO. The rest are transportation and miscellaneous costs. Going forward, we expect cost of production to increase moderately in 2014 to 2017. We have modeled an annual increase of around 4 to 5%. Even with that, we actually found out that earnings are expected to rise steadily over the next few years, thanks to the strong production growth and the low cost structure. This alone drives EPS growth of about 12% over the next 2 years, from FY13 to FY15. However, do note that we actually modeled a flattish CPO price due to our more neutral outlook on the CPO price going forward. One of the main reasons why we are neutral on the CPO price outlook is mainly due to the rising global oilseed supply. This with that, we actually see that there will be a more upside surprise should CPO price actually increase. In fact, it is like buying First Resources is like buying a put, buying a call option on the CPO price itself. Let's go. Let's go into further details on why we see CPO price being neutral in the short and medium term. One of the main reasons why is due to the rising global ICID supply. ICID supplies are mainly in particular to the soybean production. The soybean supply prospect is expected to rise from South America and the US. According to USDA, FY 2014 production is expected to increase by 7% year on year, and this should result in a rising stock usage ratio, which will actually carry on the upside on the, which will actually put pressure on the price, downward pressure on the price of soybean. This in turn should lead to lower CPO price, and that's one of the main reasons why we are pretty neutral on CPO price in the near and medium term. If you look at the diagram below, CPO price discount to soybean oil price discount is also at all-time low. Due to the fact that the soybean oil price has declined by about 20% over the past 12 months, but the CPO price remained fairly stable over the same period of time. In fact, CPO price has been hovering between somewhere to $800 US per metric ton over the past 1 year. This is fairly stable, and this has actually resulted in a CPO to soybean oil discount to narrow. Currently, the price discount is only at around $84 per metric ton, as compared to the historical average of $200. Hence, this will result in CPO to be less attractive to its substitute, to its more attractive substitute, which is soybean oil. That said, one of the reasons why we didn't call for a sell is mainly due to the fact that production is expected to recover from the biological trend. In 2013, yields were lower due to the fact that there's a bumper crop harvest in 2012. That said, in 2014, we expect the yield to recover based on our analysis on the FFB on year change, as you can see on the diagram on top. This should lead to a higher stock going forward, but the fact that the lower inventory levels in the China and India, in particular to its edible oil stockpile, should result in resilient demands going forward. This is one of the strong supporting factor that should sustain the CPO price going forward. If you're interested, you can refer to our initiation report for further details on this discussion on CPO price. And thirdly, the attractive valuation of our first resources. As you can see on the diagram, the P valuation of first resources is at attractive valuation, which of less than 10 times FY15 PE. Most of its competitors are trading at more than 10 times FY15 PE. And if you look at the PB valuation, even though it's trading at a slightly higher premium, but but don't forget, First Resources also has a higher ROE of more than 15%, this in turn should justify the higher PB in our view. So the key risk for First Resources, based on our thesis, will be that the sustained downtrend in CPO price, given the fact that more than 95% of its operating profit comes from its upstream plantation, any sustained downtrend in CPO price will definitely affect First Resources earnings, but we feel that it is highly unlikely, given the fact that we still see recent demands over in China and India. Cost inflation should there be any unexpected rise in wage or fertilizer costs, definitely it will erode margins for First Resources. But having said that, any unexpected rise in wage will also affect players industry-wide. So this should not be one of the main concerns for us. Thirdly is the unexpected fall in volume growth. If there is extreme weather such as El Nino and heavy rains will actually affect the production yield of CPO plantations. Weather is something that we cannot really predict, so this is something that we didn't really model into our first resources model. Hence, this. But having said that, we will continue to monitor the weather conditions over in Sumatra and West and East Kalimantan to give investors new updates should there be any sudden changes in the weather, which might affect plantation use going forward. So all in all, reiterate our investment rates for First Resources. First, there's a strong production growth in the next 5 years. This alone should drive earnings growth for First Resources itself at a 12% 2-year CAGR. Second is that First Resources is the lowest cost producer within the CPO sector itself, meaning First Resources is actually a quality stock to hold for investors who wants exposure over in the CPO space, plantation space. Thirdly is because of its attractive valuation. Based on our analysis industry-wide, we found that the First Resources is one of the few companies that's trading at less than 10 times FY15 PE. This is something that is hard to come by for investors who wants exposure over in the plantation space. So definitely a good stock to pick up at this point of time. We value First Resources based on the discounted cash flow valuation methodology. We have an accumulated rating for First Resources at a target price of 235. Based on the if you look at the PB chart over here on the right, you can see that currently First Resources is trading almost close to the historical long-term average of 1.7 times PB. This also shows that the valuation is undemanding at this point of time. Right. If you need further details and further discussion on this topic on our First Resources, please feel free to refer to our initiation report, which is published today. Go on, log into POEMS, and you will be able to get it. Right. So that's all we have today. Hope you guys enjoy, and yeah, Happy New Year. Right, the targeted time frame for First Resources is actually, we have a 1-year price target for First Resources, so this price target is actually like in 1 year's time.
Hi, this is a question on what's our view on the S&P and STI given the correction phase which is ongoing. Okay, for the STI, right, if you look at last week's presentation and you follow our morning analysis, for the STI, we feel that there's still no signal to go long yet. So we're still in the consolidation / bearish mode for the STI. So no clear up signal to go up yet. For the S&P, we did guide weakness for end of January and early February, and that's what we have right now. So for the S&P, same thing. We are still in the middle of a down cycle, and there is no clear signal to get back in as yet.
Hi, this is Lucas here. Any property stocks of the question is any property stocks of attractive valuations. The truth about the market right now is all property stocks are kind of have very attractive valuations. It's more, as per what I said previously also, it's more of the macro outlook on this, the macroeconomic factors on this real estate sector that's actually hurting the share price. In view of it, the market is kind of expecting another 1 or 2 more rounds that's coming out to the market to kind of like for the government to tie all the loose ends for the property market. So it's kind of a case of many individuals or rather the market as a whole having a stay out. You want to watch how it's going to react and what the government is going to come out next before making a decision. If let's say the government is coming up with just some measures to tie up the loose ends of all the previous cooling measures, then maybe there will be a turn in the market. But for now, it's kind of still very everyone is still very jittery about it. Everybody is still kind of waiting to see what is the next measure and whether the next measure is strong or weak, and also waiting to see whether there's any market movement. So to simply answer your question, property stocks of attractive valuation, actually all of them are very undervalued right now, including the big three of CapitaLand, Keppel-Land, and CDL, and also numerous other investment property holding companies. But having said that, my recommendation is to actually stay and watch first, because it's kind of like murky waters. So you can't really see beyond the next few months even. So, yep, valuation is good. Just be on the lookout. I'll actually update you guys in time to come. All right.
There's a question on the majority shareholder for First Resources. The majority shareholder for First Resources is actually controlled by this family called Fangiono family. This is, yep.
Is there anything else? Doesn't today's paper treat the macro part? Macro part? Oh, okay. Next week. Hi, just to let you guys know that for macroeconomic update as well as comprehensive market update, that will actually happen next week. Next week, Ken, the technical analyst, will spend a bit more time on the technicals next week. So, yeah.
There's a question on Noble and First Resources. Basically, we feel that Noble is not a good comparable to First Resources, given the fact that the First Resources is more of an upstream plantation company. As for Noble, it's more diversified. It do energy, metal, agriculture. So all in all, Noble is not that a good comparable for First Resources. As you can see from the from our slides, we actually come up with more better comparables for First Resources. Companies like Golden Agri, Domitama, Astra Agro, Felda, KLK, etc. So these companies are more upstream focused companies, which are better comparables for First Resources. There's a question on which are the most undervalued stocks now. If you're talking about CPO plantation stocks, which are undervalued right now, definitely is First Resources.
Respond to the question or just end it?
Extended TA, market TA, and so on. There's also one more stock being presented with me. I forgot what it was. No, it's not just me.
It is, you know.
No, I talked to Josh earlier. Hi, just for next week, right? Finally, right, we'll be doing an extended technical analysis portion where I'll be going through the macroeconomics, US market, Singapore markets, and I'll be spending that time to elaborate a little bit more on the technical indicators that I have been using. So it'll be an extended TA time. It will be half informative and half half teaching aspect. So those who are interested in technical analysis, market analysis, intermarket relationships should definitely tune in. We'll be talking a bit about sector rotation for the US as well as sector rotation for the Singapore market and what we can learn from it. Okay, so hope to see you guys next week. Question, is there any other alternative for China ETF apart from United SSE 50? Yes, one of the more liquid and lower management fee ETFs for the China market will be HK83188. Okay, let me just, yeah, HK188. Okay, the strongest sector right now is like this, okay? Because we are currently going through a correction in the bull market, so on a very short term, actually the defensive stocks have been outperforming for the last one or 2 weeks. However, once the correction is over, right, we expect the sectors to outperform will probably be industrials as well as basic materials.
Sorry, regarding the question on views and or updates on United Engineers, I think there's currently no coverage on this counter right now, so there's no comments on that. So sorry about it. And with that, we have come to the end of the webinar. Okay, sorry, there's a last minute question. Entry price for first resources. Any
Right, there's a question on the entry price for First Resources. Currently, based on the last closing price, First Resources trading at less than 10 times FY15 PE. We believe that this any price that's lower than $2 should be a good entry price for First Resources, given the long-term strong production outlook over the next 5 years. This alone should drive earnings, not to mention any upside potential in the CPO price. So yeah, that's our take. Thank you.
Alright, there's a question asking if next week's webinar is from 11:15 to 12:15. Yep, the webinar is not starting from 11:15. The end time, we always try to target it to be an hour or so, about 12:30, 12:30 is the end time. So yep, it's starting at 11:15. Alright. Alright, with that, we have come to the end of this week's webinars. Thank you all for logging in. Next week there will be some TA education by our resident analyst. He's also a holder of CMT and he's knowledgeable on it. So hope you guys can tune in for next week. Alright, thank you.